Welcome to another episode of OPTO Sessions, everyone. I'd like to introduce Kate Moore, Head of Thematic Strategy for the BlackRock Global Allocation Fund. The fund is rated gold and 4 stars by Morningstar and has $17 billion in AUM. Previously, Kate was also the Chief Investment Strategist for the private bank at JP Morgan. How are you doing today, Kate?
Yeah, I'm doing very well. I'm ready for a very big and busy week.
Yeah, I mean, are we talking about the data releases this week, or have you got other things on as well?
I wish I was talking about things other than the data releases, but unfortunately, that's a little bit of the way I live these
Yeah,
days.
okay. And where are you calling from?
I'm here in New York City at BlackRock's headquarters at Hudson Yards.
Oh, brilliant.
Yeah,
Okay, so what, Southern Manhattan? Yeah. Okay, brilliant. Yeah,
yeah.
we're calling from OPTO's based in London, in the city of London,
Okay, excellent.
over the pond. Yeah, I mean, it'd be great to start just getting some insights on the general macro from your perspective. So I thought we could start by just getting your outlook for the market for the rest of the year. It's obviously been an interesting year so far. Some inflation issues coming around at the moment. I suppose we could start there. Do you think they're over, or what should we expect for the rest of the year?
Yeah, this is a tough one. I'm going to tell you that my crystal ball feels a little bit cloudy at the moment. That said, I'm going to put out my highest conviction call right at the onset of answering this, which is to say, I do believe with high conviction that we will end the year higher in equities.
Paul loves onion volcanoes, but found himself moving miles away from the nearest hibachi. However, Paul had spent years preparing for such a move, because Paul also loves real volcanoes. Foresight's a wonderful thing. Invest in innovation, including robotics, with OPTO.
And that can sound a little controversial because a lot of strategists, a lot of people on the street have been downgrading equities to kind of more neutral at this point, especially after the strong performance in the first quarter and then the very kind of sideways trend that we've had in the second quarter thus far. So they said, maybe it's all over. Maybe we have no more juice in the tank. I don't think that's going to be the case. I think it's going to be a little bit of a bumpy ride as we digest some of the economic data, as we digest different policy moves and rhetoric, especially from the Fed, as we digest elections. But I think fundamentally, the corporate sector is in very good shape and the economy is strong enough to justify a move higher in risk assets.
And we've got, I mean, this is Monday the 13th, tomorrow's PPI, Wednesday CPI. I think this podcast will come out after that, but are you expecting there still to be some problems there on the inflation side? And is that what might cause a bit of a rocky middle of the year before picking up at the end?
Yeah, I think the inflation story is going to be obviously very closely watched. You mentioned CPI and PPI, which are critical, but there's another piece of data coming out this week at the end of the week that I think people are going to be watching very closely, which is retail sales. So we can talk about the consumer a little bit later, but let me just suggest this is going to be a week where a lot of people decide whether or not they're positioned well for the market over the next 2 months. On the inflation side, it's been frustrating to a lot of us that, parts of inflation have remained very sticky. That said, I think we have to expect, a more moderate disinflationary trend than we expected at the beginning of the year. Like internally, we've downgraded our own downgraded our own expectations for disinflation, sort of higher inflation by year end. But we still think we can get core PCE in December to 2.8%. Is that 2% the Fed wants? Not really, but it's a significant improvement, especially on a year-over-year basis. But here's what I want to say, because I've been really struggling with this. As economists, as market participants, we look at the inflation data and we say, wow, it's improving, maybe not at the pace we maybe expected 4 or 6 months ago, but certainly improving. And that's great news. But most people who don't think about data in a year-over-year basis are going, inflation doesn't look good at all. In fact, they're remembering maybe pre-pandemic or even 3 years ago what prices looked like, and it feels to them that inflation is really ugly. So I think managing that expectation around a moderate disinflation, but prices still higher than they were relative to kind of the average consumer's benchmark is going to be a real challenge for policymakers.
Yeah. how do you think that affects their decision moving forward related to rate cuts? And do you expect rate cuts to happen this year? There's a lot of back and forth going on about that at the moment. But is the Fed in a tough position? Are they going to be forced to sort of stimulate the economy before the election? There's a lot of underlying things going on, but what's your point of view on that?
So the punchline is we think that the market pricing for rate hikes right now, kind of 1 to 2 in 2024, makes a lot of sense, and we're kind of in consensus there. That said, I have to tell you, I think being a Fed decision maker, a voter, or the chair is a thankless job at this point because the economy is not moving in one step. There are lots of different multiple speeds across different consumers, across different corporate sectors. And so it's pretty difficult to make a decision that's going to benefit everyone and perhaps not overheat other places.
Yeah.
And here's where I'm going to call out kind of the low-end consumer. We've been paying very close attention over the course of first quarter reporting about what companies are saying about the low-end consumer. And it's been a pretty soggy bunch of rhetoric and narrative from these CEOs and CFOs. Many of them have said, the low-end consumer seems to have traded down, or they're visiting our stores or outlets much less frequently. There's definitely a tone of weakness there. And so the Fed has to consider that even as the aggregate data about consumers in terms of overall debt burden and incomes looks good. So how do they make these decisions? Again, this is why I don't know if I want to be a Fed decision maker.
And you mentioned retail sales, another data point you're looking at this week. Why is that so important to you? Why is that? You feel like that's a better indication of what's going to happen when compared to inflation statistics or not?
I think it's really important because, as I mentioned, we've had kind of like a sort of a mixed bunch of data, or at least a mixed bunch of stories coming out of first quarter reporting. On the one end, high-end consumer looks pretty good. The middle looks fine, but maybe trading down in terms of value. And the low end may not be spending so much. So I'm going to be watching retail sales really closely for either a corroboration or a refutation of this data, these stories that have been coming out. I will tell you, it's hard to really make a decision about the consumer just based on one bit of data like retail sales. That said, I think it would go a long way if we saw solid retail sales to restoring comfort and sentiment in the market. This weakness that we keep on talking about has really been weighing, I think, on overall activity. People are looking for the cracks in the economy. And if this is not the area that's coming up in the second quarter, if it's not the low-end consumer, I think that will help sentiment.
And do you think there are cracks in the economy that are being shrouded by things such as, I think people have been mentioning that there's high levels of debt with the consumer at the moment. Maybe that was sort of keeping the retail sales higher previously, higher than they would have been if they hadn't been taking on so much debt. Are these sort of things still around, or do you think actually the economy is pretty resilient and able to get through this?
I think the economy is pretty resilient, but let me talk a little bit about kind of what's going on in terms of the aggregate consumer data, because this is important. It is true that debt levels are high. And again, if we were to look at it by income quintiles, the bottom 20, the bottom 40, whatever, we'd get different pictures. But in aggregate, household debt service as a percentage of disposable income is less than 10%. And that is below the pre-pandemic and then certainly pre-GFC levels. So, you look at that data and you say, that's really manageable. And, mortgage debt, as much as we sort of talk about the mortgage market and how expensive it is to buy a new home, the vast majority of homeowners in the US have locked in fixed rate mortgages. It's 90% of mortgage holders. And the average effective mortgage rate is 3.8%. So, it's only the new buyers and people who are looking to trade houses that are really facing these much higher mortgage rates. I say all this because the data, there's all these cross currents. And so it's difficult to say there's one specific trend. In general, I would say the consumer looks pretty good. And in general, I would say corporate confidence, and this is something I follow very closely, has continued to improve. And that's really important for continued spending.
And what about the jobs data? What sort of insights have you been taking from the jobs data recently? Because there's been a marginal tick up, unemployment rate, etc., which previously is signified, worse at times coming forward. But obviously, the Fed is going to try and avoid that as much as they can. How do you think the Fed's going to approach this if they also have to try and control inflation whilst trying to prevent this potential economic downturn?
I'm going to say something that may be a little controversial, but I think the labor market data, barring some huge shock where we have mass layoffs, is not that important for overall risk asset sentiment, how stock investors are thinking about the market, and probably less important for the Fed. Look, the labor market was incredibly tight for an exceptionally long period of time. We actually had some sort of freeing up of some of that tightness because of immigration. So we're going to be watching what happens very closely post-election around immigration and the impact that has on service sectors. But I would say, we're going to be we're a very long way from the labor market showing signs of stress. And so I think it's really an inflation story at this point and a confidence story around both consumers and corporates as they think about spending.
And if I play the devil's advocate and say, okay, what if the scenario that inflation does go up more than expected over the next 6 months or so, what would that be? Obviously, a negative for it would constrain the Fed's hands on what they can do, and potentially that there would be a downturn, but may not be the most likely outcome. But is still a possibility? Do you think?
Look, I think you're right. If inflation were to surprise meaningfully over the course of the summer, so then we don't just have 3 or 4 hotter, warmer inflation prints, but we have something more like 6 months or 7 months of data like that, I do think that would be bad for sentiment. One of the things that I track a lot, and I keep on talking about sentiment, is CEO and CFO confidence. And what we've seen over the last couple years as inflation spiked, and at least like less inflation or a little bit of a disinflationary trend over the last 2 years, is corporate confidence around the economy has picked up. There's a very close correlation between inflation levels and confidence. And so companies, if they don't feel like they're going to be dealing with significantly higher prices, may feel more comfortable about capital expenditure and investment. The last thing we want to do is for them to say, hey, look, inflation is really high and staying high. We're going to hold off on investing because that will really put the brakes on a key part of the economy. Mm-hmm. Similarly, we know that the consumer does, acts in the same way, which is to essentially say, if prices look really high, I'm going to hold off spending today and wait for prices to come down. So if those two things happen concurrently, I'd worry a little bit. Not about a huge recession, but about something like a 1% GDP print.
Yeah. Oh, that's interesting. Thanks, Kate. I thought we could come back now to just your role at BlackRock. So you're obviously the head of thematic strategist at the BlackRock Global Allocation Fund. Could you take us through more details as to what you do day to day?
Yeah, my title's a little bit of a mouthful. So let me talk a little bit about the type of investor I am and how I approach the market. So thanks for the introduction at the beginning about the Global Allocation Fund. It is one of our largest and biggest sort of flagship funds at BlackRock, and it's been around for a long time. Functionally, it is a kind of go anywhere kind of macro fund. Some people may think of it as being benchmarked against a sort of a 60-40 portfolio, but we have many more tools in our toolkit than a traditional kind of stock and bond portfolio. And my role on the team as a fund manager is twofold. Number one, I call myself a macro equity investor, which effectively is, taking a lot of macro inputs, whether that's policy and by that I mean not just monetary, but also fiscal policy, for example, or regulation, consumer data, technological change, all of these things, in implementing them in the bottom up, but in very concentrated stock baskets between, say, 4 and 8 names. So I do this specifically so I can capture an idea, but in an unconstrained way, really, access equities that are geared to that idea. But I'm taking idiosyncratic or stock-specific risk when I do that. Some people who talk about investing in thematics, what they effectively do is, they invest in a very broad swath of companies, 40 or 50 companies that may just have very small tangential relation to the idea. I try and really isolate that idea. So that's kind of the part of the portfolio that I manage. It's high octane, it's very growth oriented, and can put up great numbers, but also has a lot more volatility.
Yeah.
The other part of my work on global allocation is more in thinking about asset allocation as someone who, as I said, is kind of macro equity and thinks about the top down and the bottom up, working with the other portfolio managers, decision makers, and our systematic team to really think about the right level of risk in the portfolio. So I still do a lot of work on what are expected relative earnings, what does sentiment and positioning look like, because that's so critical to timing the entry and exit into markets. So I have these two really awesome parts of my role. And then I do a lot of other fun stuff around BlackRock as well in terms of sponsoring women in investments, bringing in outside speakers and holding market roundtables and that kind of stuff.
And why should investors consider investing thematically? If you could just take us through your viewpoint on that.
Yeah. So as I said, a lot of thematic products that we might see in the market, for example, have many names in the fund or in the vehicle, and that they're trying to capture the general idea, but will get a lot of other stuff in there. The type of thematic investing that I do is much more concentrated and really seeks to isolate. But I also recognize that as much research as I do, I may not be able to pick the absolute winner of a thematic idea. And in fact, what makes sense is to kind of look at the vertical and to say, here are the top 2 names in each part of this process, and realize that if I'm right around the idea, the pie is going to get bigger and the top 2 or 3 competitors will each benefit. So that's my approach, and that's why it's a little bit different. But I think that's an important way to think about really capturing the essence of a structural or technological or consumer or policy change.
So let's dive into the global allocation fund's positioning a bit more. So tech is the fund's largest overweight at the moment. But starting with AI, could you take us through the opportunity here and the broad group of companies that are related to this theme?
Global allocation has been, I think, a lot of investors who are excited about this technology overweight this group of stocks. But we also recognize that there are multiple different ways to invest in AI. And it's not just say we have to do the hardware, but it's also like, where's the plumbing? Where are the software companies? Who are the cloud enablers? And who are the real beneficiaries of spend at this point? The one thing I keep on asking myself, though, and this is kind of a multi-year idea around AI, is if we look at some of the most inefficient industries in the U.S. market, for example, let's call it like around or most kind of capital intensive manufacturing, industrials and stuff. Right now, we're very excited about, the AI spend for the chips and software and cloud, right? But in the future, it's going to be these more old industries that can really be the most transformed by AI and technology. So this is a couple years out. I want to hear how these companies are thinking about investing, the use cases they're seeing, and whether or not they're really going to be able to realize, efficiency and productivity gains from making AI investments now. I think that's going to be exciting. Right now, it's all about the core group of names. In the future, we're going to find the winners and losers in every industry, and particularly in some of the old industries that really need to upgrade their efficiency. And I think it's going to lead to a great amount of alpha opportunity.
And if we're talking about sort of more hardware-related improvements, probably through robotics and AI together for some of these industries you're talking about, who do you think will benefit the most? The companies that are creating these robots, utilizing AI for these industries, or some of the players in those industries that are buying this technology to improve the way their business operates?
Yeah, this is one of the time horizons things. In the very near term, I don't actually think we have a great sense for demand for any of these AI chips. People put estimates out there. It's based on existing purchase orders and then kind of scaling that up and thinking about sort of a terminal rate of that growth. But the truth of the matter is, as more and more companies develop and establish use cases for this technology, and as it gets more advanced, and as we work out some of our concerns around power generation and who owns what data, I think the use cases are going to expand exponentially. So I think the demand for the hardware, we're only at the very beginning stages of having an idea of what that might be. And so right now, that is definitely a place where we want to have more concentrated risk. But your point is like very well taken. The companies that invest in the AI and the robotics and the automation and smart systems that increase their productivity are going to be the winners longer term as some of the chips and as some of the software and stuff becomes more commoditized. I just don't think we're there yet.
Yeah. Okay. But obviously, as the market's forward-looking, we're anticipating this change through many companies. You're seeing it early with the semiconductors, obviously, but obviously the revenues you can see are going up substantially as well. These companies in particular have risen a huge amount over the last year. Sometimes the market can get ahead of itself. Do you think we're at this point now, or actually, as many people are saying that many people are underestimating the potential of where this can go? And actually, it's fully justified what's happening now because they're anticipating what the valuations will be in the future.
Yeah, some of the companies that have reported first quarter, have put good numbers and they raised guidance, but maybe didn't raise guidance as much as, the investment community wanted them to. So I think in that case, we would say sentiment ran ahead of actual performance and actual potential performance over the next couple quarters. But I think we're just kind of in a consolidation period where everyone is resizing the overall market. And I think there's more potential for us to kind of upgrade our overall demand picture.
And if you look at the more classic AI companies, that are companies such like Google, Microsoft, the people that are sort of utilizing the software, you've got the semiconductor companies, and others, and more themes are going to develop in this AI, sub-themes in this AI sector at the moment. But who do you think stands to benefit the most if you were sort of looking at it today? Do you think it's a picks and shovels sort of approach, and the semis are one of the best to invest in, as long as those companies that do benefit? Obviously, not all semiconductor companies are going to get big market share. Nvidia owns a lot of it at the moment, but do you think the semis are going to overall sort of win out, regardless of how this sort of moves going forward?
Yeah, let me just say we're overweight semis right now. So in the near term, we definitely see them as being winners. But your question is sort of well taken here. And I will say the companies who I think who are going to win the most during this AI revolution are those that own the data. I mean, because the AI systems themselves are going to become more standardized. These models will be able to apply to lots of different data sets. The hardware companies will have more competition over time. But if you have access to strong, solid, proprietary data that allows you to improve how you do business, perhaps this is controversial, no one wants to talk about it, cut headcount, reduce overall operating expense. I think that's going to be the real differentiator in the future within all different industries. So when we talk about kind of the big players, some of them really own some amazing data on their users. They are, global behemoths who understand how consumers and companies use their applications, what kinds of things they search for, what data is important for decision making. I mean, I think that's going to be critical. But even within let's say a consumer company who's done a great job of collecting data and has a captive consumer base and continues to interact with their consumers, I mean, that data is going to be incredibly valuable because it's going to allow them to make changes to their product line, how they deliver their inventories, and how they increase incremental sales with the captive consumers.
And do you have an inkling of what the next areas might be after the semiconductors, or is that sort of top secret at the moment?
Well, I think there's a lot of debate. You've seen the market getting really excited as we have all wrapped our head around how much power and energy needs to go into, AI and AI-related generation. Everyone's gotten so excited. They've thought, okay, like here are the utilities that may benefit, or here are the renewable technologies that may benefit. And there's been a big run up in some of these stock prices. I think this is a multi-year. The power generation is a multi-year investment, and we're very excited about investing at BlackRock in the infrastructure to supply data centers, but recognize that the market sentiment has gotten ahead of reality. I do think that, and it's probably not in the second quarter, probably not even in the third quarter, we're going to hear more companies showcasing their use cases of AI, and it's going to get people really excited. And I don't know exactly what all of them are at this point. We have some speculation. I've mentioned a couple examples around consumer in particular. I think if we hear more industrial companies talk about how they're using specific technologies that will make people feel better about their margins going forward. But I wish I had a crystal ball there because I'd buy all of the stuff in advance. But all I can tell you is we'll be watching the information very closely.
And do you think there's actually a scenario where it becomes more of a monopoly towards NVIDIA because it's able to spend enough money to stay ahead of the competitors? Is that a potential scenario as well? Because the people are just going to want the best chips. So if NVIDIA has the best chips, I don't know why you go to anywhere else.
Well, you go someplace else because NVIDIA can't supply you. I mean, this is a supply demand issue. They say if this chip is good enough, maybe it's not as premier as an NVIDIA product. You will consider buying or at least supplementing your supply from other places. But you ask a really good question around monopoly. And this is a thing we've been debating at BlackRock a little bit, which is what does the regulatory landscape look like over the next couple years? Because both Europe and the US are taking a good look, not just at these use cases for AI and what that does to different worker populations, but they're also taking a good use at who's using what data, how we can verify that data, and if there are companies that are kind of taking too much market share, have too much control. I think this is going to be a critical area of regulatory and policy debate. But here's a great piece of data that came out from the Richmond Fed, St. Louis Fed CFO survey for the first quarter. They asked some special questions to companies about how they're spending on technology, and technology specifically, not to replace, but to augment what they get out of their labor force, considering that labor cost and labor supply was a really big area of concern. And what we found is that a significant portion, more than half of companies said over the last 12 months, they've invested in this technology. But when you break it down between large companies and small companies, it's almost 80%, it's like 76 or 78% of large companies have made that investment, and quite a small percentage of sub 50, 45% or so of small companies. And this is where I think the regulatory side gets really interesting, because if the large companies who have a huge amount of cash and a lot of capital to access and geographically diverse sales and all these different income streams are able to invest more in the technology that improves their efficiency, and the small companies don't have the capital and the small companies are kind of struggling to make these investments, I think regulators may step in and say we need to even the playing field. We don't want more monopolies or oligopolies created in all these different industries because small businesses can't compete. So I'm watching that.
And I think I'm right in saying the CHIPS Act in the States are they providing subsidies to sort of domestic chip production in the USA? Do you think that's going to position the USA as a stronger sort of competitor worldwide for making chips?
I think there's a great potential for the U.S. to make a lot more chips. In terms of, how fast that production ramp up is, I don't have a great number. There are probably better experts than me to discuss that. But I do think we're going to see a lot more governments invest in domestic companies to compete and to make sure that their own ecosystems stay competitive if global trade slows. So I expect a lot more government support in this area.
And as head of Thematic Strategy, your mandate includes identifying opportunities to exploit structural change, policy evolution, and dislocations across global industries. Can you take us through some other examples of opportunities you see today, perhaps starting with your favored regions globally?
Yeah. Another area that we've been doing a lot of work and I think makes a lot of sense for investing in medium term is around industrial automation. It's not necessarily related to AI, but and this is to improve efficiency of production when companies look to reshore, onshore their production.
Mm-hmm.
So this is a geopolitically driven and a politically driven decision. In many cases, companies receive a lot of pressure, but in order to switch their operations, they need to make sure that their operations in the new location are very cost effective. So we think we're going to see, both as a result of labor and this sort of political and geopolitical tailwind, more investment in industrial automation going forward. So I think that's a cool theme, and probably is good for all of us, increasing efficiency. Another area I'm watching really closely, we've talked a lot about the consumer, is emerging consumer trends. Something that's been interesting is that, even as consumers have pulled back on some goods purchases, their willingness to spend a lot on experiences and events has remained really robust. And so trying to access, some of the investments that are related to that. I mean, that's a awesome theme to think about over the medium term. We all care a lot about the vacations, the experiences with our people, and a little bit more than perhaps some of the consumer goods that were important before the pandemic. Those are two themes I'm thinking about. I'm also looking at a lot of the tech and AI adjacent themes, looking for differentiated ways to play. But I've been really constructive on cybersecurity companies as well. That's been one of my longest holding themes in the portfolio. And every time I think, wow, this has been an amazing run, there is another event that propels them higher. So, I think cyber threats, government and corporate investment in that space are not going anywhere. And in fact, some of these companies are becoming so essential to the day-to-day operations of a huge swath of industries.
So you see industries, businesses spending more of a percentage of their revenues on cyber security moving forward due to the threats,
And also, no one can afford to have an operational error. No one can afford to have, a disruption to their business. And so it's more like, as they look at their tech budgets, they say, what are the things that are most important for us to spend on? Let's just say we were to have a weaker economic environment in the next year, which is not our base case. But that is an area where I think would be the least likely to be cut in terms of spending. Companies just can't afford to take the risk. And those companies that are vulnerable are going to be the relative losers.
And do you see the attacks becoming more sophisticated, which is one of the reasons why the need for increased expenditure on cyber?
Yeah, they're becoming more sophisticated. They're becoming more strategic and targeted. And this is true, of course, across, government assets and corporate assets. So, and I would say this, as more and more people store their data in the cloud, as more and more people use some of, AI technologies, it's showing, CTOs, chief technology officers and chief investment officers, they need to spend more in this area to secure kind of the future of their AI technology.
Yeah. And just coming back to the industrial automation, have you got a viewpoint on the humanoid robots, which is propping up as a interesting theme at the moment? Obviously, Elon Musk, one of the main players in that theme, I believe he said something relatively soon that they'll be using these in factories. What are your thoughts on that? Do you think that's a possibility, or do you think the potential's there for these sort of innovations to increase efficiencies?
I've seen some really intriguing and somewhat scary videos, but I can't say I'm an expert on the humanoid robots. When we think about the industrial automation, it's not just simply about those types of robots, but also kind of more complex systems. So I'll be watching that space really closely. I'm not sure I want a humanoid robot in my home at the moment, not Jetson style.
Yeah, some scary things to think about that too. But yeah, I mean, this intersection of AI with robotics is pretty interesting. I think over the next 5 years, there's going to be some pretty incredible changes in all these areas that you discussed. Well, Kate, thanks so much for your time today. Really interesting to go through all these themes and topics with you, especially the macro as well, which is also so important. Do you have anything you'd like to say before we wrap up, or are we all good?
No, I think maybe the last thing I would say is there are a lot of reasons to be optimistic. We spend a lot of time talking about what could go wrong around inflation, what could go wrong on the consumer, what could go wrong in terms of, AI spend, regulation, geopolitical fragmentation. And yet, I still, as I mentioned at the onset, believe that equities are going to end the year higher and that corporate health is in exceptional shape. So that's my positive note to end on.
Thanks, Kate. Yeah, that's good news for most people here, I think, who are looking for a shining light after this couple of years of tough years in the equity markets. Thanks so much, Kate, for your insights today. Really appreciate it. Hope you have the chance to do it again soon.
Cheers. Thank you.